Welcome into this week's Research Corner. I'm Senior Analyst here at FreightWaves, Tony Mulvey, joined on the phone by Kevin Hill. Kevin, how are you?
Hey, Tony, how are you?
I can't complain. You know, it's not raining here in Freight Alley anymore, so not going to complain about that. But we're in the middle of earnings season. We're really started to see kind of these trends develop, especially on the brokerage side, of margin expansion. And we're going to kind of cover on why we're seeing that margin expansion and what we saw from some of these larger brokers. I mean, we'll talk about C.H. Robinson. Talk about J.B. Hunt's brokerage, considering it's all the investment that they've put into that. And then we'll talk about Landstar that's kind of seen an opposite trend in that margin. They've actually experienced margin compression during the second quarter. But first, we'll bring up a chart here. It'll be our van initial contract rate per mile, and then we'll see our national truckload index, right? And we talk about brokers and how they make money. They make money on this volatility in the market. You look at this chart, and you see contract rates pretty stable at these high levels, but what you saw during the second quarter was spot rates really fall off a cliff, right? Especially in the beginning. Then they kind of stabilized at these extremely, I don't want to say low levels, because I mean, we're still talking at the NTIL right around that $2 a mile, but I mean, from where they were to where they are now, it is falling off a cliff.
It did, and $2 a mile is, I wouldn't consider that, it's certainly the height of pandemic or a lot of times in 2019. You're talking about $1.50 a mile. Now, those are $1.50 and below, I should say. Those are low rates. $2 isn't the end of the world sometimes. So it depends on your economics, of course. But what we're seeing, especially with the 3PLs right now, is that the spot market has collapsed. The contract market is still elevated, and a lot of reasons is because those new deals that were signed in the fourth quarter of last year and first quarter of this year have just gone into effect, and it's kind of sucked some of the loads out of the spot market, which makes it a little bit overcapacity environment for that. But this is the part of the cycle where. And it doesn't last forever. That's the thing. But you see margin expansion, and it's something that we've seen from all the 3PLs. C.H. Robinson being one of the bellwethers in that group.
Yeah, I mean, we'll pull up. We've got a chart of their NAST gross margin, and you see it grew. I mean, it climbed 290 basis points year over year. I mean, that's a pretty big jump to 15.1%. But you start reading into their earnings release, they increased truckload volume by 2%, which is good considering overall volumes fell throughout the quarter. You saw they increased their rate to customers by 1.5% year over year, but they pushed down their line haul costs, so what they're paying to carriers, by 5%. And you put that all together, and you see this jump. It's not a surprise.
It's not a surprise, and it is a cycle. So please remember, it is a cycle, and this is part of the cycle that we're in right now. This won't last forever. These conditions won't last forever. So you take advantage of it as you can. A lot of 3PLs may be private. You're probably going to see a little bit less volume, load volumes come through, but you have margin expansion from that. But when you have contract rates that are somewhat stable right now in a falling spot market, you're expanding those margins. Contract rates will follow. Probably in the second half of the year, we're already seeing it quite a bit. And, some channels checks, I think mid-single digits, maybe all the way up to double digits. You saw a lot of double-digit increases in this last contract cycle. You might see some double-digit decreases as well if you're looking, and certainly if you're comparing to the spot market, and that's what everyone does. That's the benchmark.
Yeah, and we talk about CH because, I mean, before we had Echo, which was public too, and you had two kind of big pure play 3PLs, yeah, and now you really don't. With Echo being taken private, you really just have CH until you see the XPO spinoff a little later this year. But what you see in other earnings, right? Every major truckload carrier has a brokerage, but their brokerage, what they use the brokerage for ultimately is a little different than that pure play, right? They have to keep their assets moving to drive the truckload segment of their business or enhance their network.
It's an operating segment. It's an important part of their business, but it is part of their business. So it's a little bit different than a pure play where you're all in on being a 3PL. So there's a slight difference in mentality there, and you kind of see that in the results and kind of how the business operates and functions overall, or that 3PL piece of it.
Yeah, and that's why I bring up JB Hunt, right? I mean, their business is a little diversified than maybe like a Knight-Swift that has a brokerage division, but it's not a larger part, because you start to see the investment that JB Hunt's made over the past few years, and you start digging into their results in their brokerage. I mean, you look, revenue up 3% on 3% down volume year over year. Their margin expanded 570 basis points up to 16.2%. So I mean, it's the same trend. And you talked about the shift from contract to spot. I mean, prime example: 54% of their volume in the brokerage was under contract, compared to 48% last year, and 48% of the revenue was from contract, up compared to 35% last year. So I mean, you're seeing it happen kind of across the board.
Yeah, this is the great time to be a 3PL or to run a 3PL, right? When you have this mismatch and volatility where you're making out, right? The other side of the coin, when the market's heating up and you have your contracted rates in place and the spot market is accelerating and your margins are narrowing, is not the greatest time, but you make up on it on load volume in a lot of respects. So it's kind of this give and take of the volatility of being a freight broker and playing the market like you're in the stock market or day trading. It's oftentimes it has those same dynamics. It really does.
Yeah, and the last one where we actually saw, it is a 3PL, but the business model itself is different, right? They attach themselves leased on owner operators. We do have a chart. It's our quarter over quarter change. We see it turn negative for Landstar's BCOs. What you saw, margins were down 60 basis points year over year. So I mean, it's not all. It's just, I think this is more of the business model that Landstar takes compared to, say, a CH or a JB Hunt brokerage, and that's where you're seeing this margin compression.
I think you are too. I think it's a little bit different business model. You see the BCOs, at least on owner operators there, though that has a great indication of where the market's going as well. Is one of those early indicators. And certainly I haven't talked too much about AB5 and how that might affect Landstar, and I don't think they talked about too much in their earnings call, from what I recall. But that'll be interesting to see on Landstar going forward as AB5 and kind of what that means for that business model, because it's pretty heavily into lease on owner operators. So what does that really mean? So
awesome. Well,
it'll be interesting.
Yeah, for sure. We'll keep track of it. But that's all the time we have today for this Research Corner. Thank you for joining me, Kevin. Right now, we'll take a quick break, but we'll be back with more FreightWaves Now.